Welcome everyone to the Sage Capital webinar, Capturing Active Returns in the New Normal Market. My name is James Biggins and I'm a Sales Director at Channel Capital. We are the distribution partner for Sage Capital. I'm just going to leave up the disclaimer page. Sean, if you can flick to both of them, that would be great. Awesome. And if you can flick to the next slide, that'd be great. Sage Capital is an Australian long-short equity manager based in Sydney with two investment strategies. We've got the Sage Capital Equity Plus Fund and the Sage Capital Absolute Return Fund. Today, I'm joined by Sean Fenton, Managing Director and Portfolio Manager, and James Delaney, Portfolio Manager. James and Sean will provide their perspectives on consumer spending, how it has shifted 1 year after the lockdown, and has the market factored in these shifts, the housing boom, how long can this continue, the case for market neutral investing. There's tilting towards certain styles. So think growth, value or quality always reward investors, and portfolio positioning and performance for Sage Capital long-short strategies that I mentioned above. I might just give a brief background on both Sean and James. So Sean is the Managing Director and Founder of Sage Capital. Sean is a highly experienced fundamental and quantitative investor with more than 20 years industry experience managing Australian equity investment mandates. Prior to founding Sage, Sean was portfolio manager at Tribeca Investment Partners for 14 years, where he managed the Alpha Plus long-short fund since inception in 2006. James is a portfolio manager and responsible for specific sector company analysis. James has over 10 years investment experience, and prior to joining Sage Capital, spent over 8 years as an investment analyst with Tribeca Investment Partners, covering financials, telecommunications, technology, and real estate sectors. I think when myself and the Channel Capital team go out and talk to investors, we see a number of reasons for people considering a long-short strategy in their portfolios. And I'll kind of highlight a few of them where, with a low-yield world, we see return expectations across traditional asset classes looking challenged. Also with long-short investing, if it's done correctly, we see a consistency of returns, and it also adds diversification benefits to multi-asset portfolios. Today, the webinar is going to run till 1:15. We've got, obviously, as everyone's familiar with Zoom, there's a question box, and we'd love to answer the questions, and you can submit them throughout the presentation, and we will address them at the end of the presentation. So good afternoon, Sean and James. Thanks for your time. So Sean, I might start with you, and it'd be great if you could share with our audience more about Sage Capital and how the team selects stocks, how you rank and research the universe, and the performance of putting all that together would be great. Thanks.
Thanks, James, and thanks for joining us, everyone, this afternoon. So, yeah, definitely, and I guess, in terms of our title of this presentation, Active Returns in the New Normal, I'm not a big fan of the new normal normally because investment markets are always changing, but we're certainly in an environment now where things are different, and it's probably just worth touching on how we go about active investing in that environment and how the Sage process works through that environment. So obviously, stating the obvious, COVID has brought some major gyrations around markets. We've had massive interventions from governments fiscally and central banks in a monetary sense, and this has created some very interesting markets, from collapse last year to a surge. We've had great news on vaccines, and that's kicked off a lot of rotation in markets. So in the last couple of quarters, we've seen big rotation from growth back to cyclicals and value as economies have recovered and yield curves have steepened. And this provides a challenging environment for investors. So exactly how we go about picking stocks in that environment and how we use that process is really important. So just a brief recap on how we go about things, and quite importantly, one of the things that we do is very core to our philosophy and approach at Sage is grouping stocks across the ASX 200, the investable universe, into 8 unique groups. And there you can see in the very fine print listed at the bottom there, things like domestic and global cyclicals, defensives, gold and resources, growth stocks, REITs and yield. And these groups of stocks largely tend to cluster together in those different environments. So whether we're in an environment of panic and the world's ending, or recovery, or cyclical rotation, by really focusing on selecting stocks within those groups and keeping some pretty tight risk control in terms of how the portfolio is positioned between them, that enables us to really use our stock selection process to identify companies that are benefiting or under pressure in that different environment, but also those that are independently doing good things or under structural pressure, and really extract active investment returns without necessarily having to take a massive view on actually how things will pan out. Will we have 20% unemployment and a Great Depression, or will things bounce back very quickly, and where are bond yields going? So making a lot of different investment decisions using our investment process, our quantitative approach, which ranks stocks right across the market using momentum, value and quality factors, as well as our in-depth company research, where we really drill down understanding how companies make their money and coming up with a range of long and short conviction ideas there. So applying that investment process over a whole range of stocks in a diversified fashion in that very controlled fashion means that we can consistently deliver active returns, whatever the market environment is. So whether it's the new normal of COVID and how we recover from there, and central and government support for markets, or some other shifting market environment, it's a process that works through that environment. And that long-short structure, being able to go both long and short, means that we can extract value there, both in our absolute return fund, so really stripping out market movements, relying on our stock selection skill, as well as our equity plus fund, which enables us to enhance ASX 200 returns. So both those long-short portfolios, over 100 active stock positions, mean that we can really rely on our investment process in differentiating winners and losers within different stocks within those groupings, really focused down where we can add value and control areas where we need to think about risk a little bit more. So a lot of you may have seen this chart before. I won't belabor the point, but that's pointing out that investment process a little bit more graphically. So the quant process, ranking things using those different factors from best to worst, left to right there, independently looking at companies from a fundamental perspective, and that combines together to give us a very broad ranking of stocks, a lot of information about companies, leveraging behavioural biases on the quant side, as well as in-depth understanding of companies, who's doing well and poorly from the earnings front. So it's a very broad, powerful investment process that really helps us build our portfolios. And as I mentioned before, the two funds, the absolute return fund targeting 8 to 10% above cash with a volatility target around there. You can see in the top chart, so just pure long and short exposure above a cash benchmark, and the equity plus fund taking those active positions and adding it onto the ASX 200 gives the equity plus fund, which gives both exposure to equity markets as well as the stock selection skills from Sage, targeting 4 to 5% above the ASX 200. So that's a brief recap of the investment process. Obviously, it's been working well for us. So you can see strong annualised performance numbers there since inception across both our funds, and pretty consistent performance across a range of different market environments. So that's the whole core point of being style and cycle neutral, that we can deliver strong returns in different market environments, whichever new normal we happen to be floating around in at the time. So moving on maybe to a little bit more of the interesting part of our discussion today in terms of what are some of the thematics actually driving through markets, how is that influencing stock selection, and where we need to control for risk in different areas there. So one of the areas that we've focused on here is how long can the housing boom continue. So housing booms are just a way of life being Australians. We all see house prices rocketing up, and every good crisis seems to bring a nice boom, and that's not a coincidence, because the Reserve Bank tends to inject the economy with liquidity, drive rates down, and drive a pricing cycle. But I think what's really interesting about the current dynamics across the housing markets is some of the disconnections with fundamentals and shifting patterns there. So yes, we've got rates at record lows, so cash rate at 10 basis points, and the RBA fixing money right out across 3 years has driven fixed mortgage rates down, and certainly driven a lot of pricing strength there. But only a year ago we were worried about housing construction markets collapsing, largely because immigration had been cut to zero, so some of those fundamentals of the housing market have been taken away. And we're still in that position. There's been a lot of apartments built from the previous boom, potentially some oversupply there. Despite that, though, we've seen a real surge in demand for new homes, but particularly detached homes, and that's been obviously helped by low rates, but also government home builder grants and helped to drive a bit of activity there. But what we've seen, I think, is really a pull forward of household formation. So certainly COVID's changed people's spending patterns, but also desires. So desire for more space, maybe getting out of share accommodation or the parents' basement, but also people buying extra homes. So being able to work remotely, do more of these Zoom-style calls. You can work up and down the coast. So demand for holiday homes also seems to have gone up. So that's created some really interesting dynamics across the market with multi-dwelling and detached housing. And within the market, across building materials, which all sit in our broad domestic cyclical sector, as well as some of the REITs across there, they've got different exposures to some relative winners and losers in that building sense. And we've got James with us today who I think might run through, give us a little bit of insight across different parts of the market. Who's these different trends that we're seeing? Detached housing outperforming high density. Who wins and loses on a stock sense out of this dynamic?
Well, probably the biggest winner out of that detached housing boom has been CSR and continues to be CSR. Its exposure to detached housing is probably the largest out of the domestic players in the market. James Hardie is a similar sort of position, but also in the US. This is importantly a global phenomenon we're seeing around housing. Interest rates were cut to emergency levels across the world as a result of COVID, and one of the surprises I think for many people coming out of COVID was the strength of the housing market. And James Hardie has a huge exposure to detached housing in the US, and also the renovation market that has been really strong. On the sort of flip side of that, ABC Adelaide Brighton has a higher exposure to the apartment space, which has been hit by a combination of both oversupply heading into COVID and the lack of students coming in, meaning there's a excess supply in that market that's been reasonably soggy. There's been a disconnect in performance, house price performance across Melbourne and Sydney between detached housing and apartment builds.
Certainly breaking down that booming housing demand. Within there, we're seeing detached housing at record highs, but really multi-dwelling apartments peaked back in probably 2018-19. New construction, the financial system inquiry really that clamped down on credit saw activity peak out there, and it's actually continued to decline. And I guess Adelaide Brighton, or ADBRA actually, they've changed their name these days. Should point out. Also, infrastructure spending demand. So obviously, there's cement produced into concrete. Infrastructure demand was touted as an area of stimulus, but don't seem to have actually seen too much of that recently from government.
I think we'll touch on Adelaide Brighton a bit later in a bit more detail. But the apartments have also struggled too because of the desire for more space, and the clamp down post the Royal Commission to investor lending too was a sort of a handbrake on overall demand for apartments. And going into investor lending, there's probably two stocks to touch on there. AFG is a stock we've been long for some time and continues to perform. The household lending market's just been amazing. Its lending growth figures just continue to surprise me upside. And what a benefit for AFG too, having its own securitisation book and its own loan book that it white labels for banks such as Bendigo, is that the cost of funding has come down massively across the market, and particularly corporate credit spreads for second-tier borrowers like AFG, second-tier lenders like AFG. It means that their margins are increasing, the loan growth is great across the board. It's really in a strong position. I think it will continue to be in a strong position over the next sort of 12 months.
Yeah, so I guess there's different aspects of that housing cycle we can get exposure to there, either construction volume, but obviously house prices being very strong as well, mortgage growth demand there. We're seeing increasing the size of new mortgages, but frequency as well. We've seen booming demand for mortgages. But even in general, with house prices booming, obviously a bit of a benefit to their book being a mortgage insurer as well.
Yeah, they're an interesting one. They obviously had the same idea that the housing market was going to tank late last year, around sort of March, April, took large provisions for the book, right down to its book value. And going out sort of 12 months from that, the big surprise has been the housing strength. So it's running with a excessive provision across the book that's likely to be lifted the second half of the year, much like the banks are starting to lift their provisions across the housing market. So there's real value in that name, and there's just no bad debts because the house price has gone up so much. Mortgage insurance written 2 years ago is pretty much all in the money now.
Yep. So they're books have been matured very well and certainly far better than they would have expected when taking provisions a year ago. So some conservative accounting there and potential upside at next result. So we've been talking a bit about house prices and, people like to chat about this around barbecues. I'm not sure that, top end of our range there, up by 10% enough. Maybe it should have been up by 50%, but if you're so inclined, please feel free to participate in our poll and let's see where consensus sit in terms of where house prices might be in 12 months' time. I think I can do this poll myself. So, we'll wait for a little bit for some of those results to be collated and pop back up there. What do you think, James? Where are house prices going?
They probably already have risen by 10%. There's been a bit of a lag in the reporting, as we're sort of
We do notice that a lot.
The Canadian market is New Zealand market in particular of sort of instances where it has gone up by a lot more than 10% in a very short period of time. But going forward, we are likely to see some incremental tightening from the RBA, just removing that 3-year fixed sort of levy, probably second half of the year that they're going to relieve that subsidy.
And we saw that in Canada last night, tapering bond purchases and talking about prospect of maybe tightening a little bit earlier than previously, and we've seen some macroprudential controls implemented within New Zealand. Is that on the cards for Australia?
It's pretty hard to do that in Australia. New Zealand was more of an investor-led boom, and Australia really has seen minimal investor demand since the Royal Commission about 2 years ago. So the RBA's comments recently around the housing market have been quite supportive in terms of the quality of lending being made and the lack of investor demand. So I think they're a bit slower to the party than either the Canadians or RBNZ, but they will get there.
Yep, and so our poll results coming back in. Not surprisingly, 2/3 of participants today say rise up by 10%, 20% a rise by more than 10%. So maybe we're getting towards the tail end of this boom, and the punch bowl may be taken away from the party down the track. So that's definitely worth keeping an eye on, and that obviously drives demand for housing. And one of the things that we have seen in the past, when we do get these episodes of very strong housing price growth, it is a big multiplier through the economy, so it drives housing construction, a lot of ancillary retail purchases, car sales. If you can get a car these days, it tends to be highly correlated with house prices, as well as furniture, electrical, a lot of retail. But it does also bring with it generally a high debt burden when finance is used to drive those prices. So we have in the past seen hangovers in a retail sense from these sort of booms. So it is worth certainly keeping an eye on policy. And it's not necessarily when house prices fall, but certainly when that growth tends to taper out and we potentially have a bit of overbuild or a bit of activity, and you see spending can shift as people tend to start paying down mortgages as opposed to consuming, and that can be a real headwind. So the sugar hit of low rates and surging house prices, there can be a cost down the track for that, and that's something that we spend a lot of time looking at, because that's when we might start to look to rotate out of some of those builders and look at some of the other retail stocks as well. So moving on from housing, something else that's obviously been driving markets is vaccine development. We've seen really positive results out of all the vaccine candidates out there, particularly the messenger RNA vaccines from Pfizer and Moderna. Obviously, a few clotting style issues with AstraZeneca and maybe the Johnson & Johnson vaccine out there. So that's created some issues around reopening, certainly for Australia, the pace of vaccination and what we can achieve there. But you've also seen in unvaccinated populations around the world, particularly in emerging markets, Brazil and now India, seeing huge surge in cases, and parts of Europe having surges again. When do we actually get back to international travel? And the longer that takes, who suffers from that? How do we think about reopening and domestic reopening versus reopening our international borders? What does that mean for stocks in the market?
Well, some of the stocks we were actually long last year there were both Flight Centre and Webjet. We were long the tail half of last year and early this year, and their valuations just ran up a long way. I think everyone got optimistic about the speed at which the vaccine can be rolled out. There are a lot of aggressive targets. The Australian government's walked back from several targets so far. We're not the only government that has information about the vaccines that's come out. Those names are in very interesting positions too, because they do have relatively stretched valuations with a strong recovery sort of factored into them, and relatively weak balance sheets. They've got some fixed overheads, particularly Flight Centre with all of its corporate stores. It probably only has about 12 months worth of cash burn, and any delay to the vaccinations mean that they are in a particular risk category for delays to international travel and the return to probably the new normal. And one of the things that we're sort of cognizant of is that they may need to raise equity going forward in the future.
Yep, no, definitely. So we're pointing out that while there's some losers, we might use it as funding, like we've got corporate travel on the long side, and that's also impacted a little bit by international travel restrictions, but there's a lot more domestic corporate travel that occurs, and particularly as they're expanding to the US, which is a large corporate travel market, and obviously US vaccination progress has been, despite having worse experience with COVID, half the population is now vaccinated, on track to be fully vaccinated in a couple of months' time. So reopening is pretty much moving at pace within the US.
Well, even domestically, we saw in their update the other day, I think it was actually yesterday, 85% return to normalcy in corporate travel domestically. There's no COVID cases within Australia, and I think people are getting back to the point where they're happy to travel interstate and do a bit of that travelling that maybe they put off over the last 6 months. I know you've been down to Melbourne to see a couple of investors over the last couple of months, so I think that's sort of a return to normal and a bit of advantage for corporate travel versus some of these more international recreation travel names.
Yeah, definitely. So, staggered reopen, very, very interesting. I guess the other losers there have closed borders, the education sector. There's not too much listed exposure there, but certainly the university sector under pressure there with international students. And it'll certainly be interesting how the government approaches policy for migration when international borders do reopen, which will be at some stage down the track. Whether there's a catch-up policy for migration, that'll obviously be very important for things like international students, but also housing demand and the like down the track. So worth keeping an eye on that space. Another area that's been changing around, shift in consumer spending. So obviously, as we're all not able to travel as much, we'll cancel our ski holidays to Aspen. It's been pretty terrible. Out there buying a new PlayStation if you can get one, something like that. We're all spending more money on stuff. So we've seen booming sales from a lot of the retailers out there in a whole range of different categories. Some of that's starting to normalise, like food demand in supermarkets and the like, as pantry stocking's unwound, but there's persistent trends in other areas. So these shifts in consumer spending, how do they normalise? Who are the winners? How do we think about that in the medium term?
Well, as we said, if recreational travel is off the table, people are generally going to spend their money somewhere. So we're sort of looking for retailers with a real digital capability who may have been forgotten post-COVID. There's some COVID winners there that continue to print strong results who sort of been left to the wayside of the market as it rotated very quickly towards a cyclical recovery. Some of the names we really like there are Accent Group that owns Platypus, Athlete's Foot, and Hype Shoes. That continues to be strong. Their online sort of digital capabilities look really good versus its competitors. And it's got a store rollout, which is sort of important to us too, because we don't really just want pure exposure to to consumer spend. We're really looking for something there with a bit of a growth story medium term for the name. Breville's a similar one. We've seen really strong results out of Delaney recently, internationally.
Yep, everyone needs a new coffee machine and a juicer. So,
you keep telling me.
Yep, apparently. And that's tied into one of our previous thematics of housing construction as well. So a lot of home appliances, renovations, new construction, you get a new kitchen, you're going to put a new sandwich maker and coffee machine and blender and stuff in there. So those dynamics are very supportive for something like Breville, but obviously, as you're saying, something that's got underlying store rollout as well can do very well. JB Hi-Fi doesn't have as strong a store rollout, but has been doing very well and has managed to grow its business through a whole range of cycles as well. So it's certainly hasn't struggled through COVID, and it's fair to say it might be over-earning now, but as those retailers, the other thing that I guess ties them together, the things that we look for, those digital capabilities, the ability to do online fulfillment, and JB Hi-Fi in that sense, don't really like the term omni-channel, but they do have a website, click and collect, shop in store, delivery
too, which is really important. Most people have a store within 20 minutes that can easily deliver within the same day. It's a real advantage over some of their online competitors such as Kogan that rely on big fulfillment centres and they have to ship out, and getting same day delivery is going to be very difficult for those operators and may involve a decent CapEx spend.
Yeah, so they've done very well in terms of changing their business model for the conditions and really leveraging their strengths there.
I think a key point too with some of these examples is they have been left behind, and there are some names that are still printing good results, like AP Eagers in the used car market, that has not really been left behind and is definitely over earnings in a similar category to JB, but the market's sort of not considering it to be a temporary winner. They're thinking it as a persistent winner. Yeah,
so there's definitely over earners in retail, but by the same token, with that delayed reopening, some of these trends might persist for a little bit longer, but also there'll be some permanent changes and businesses that actually leverage themselves and grow a bit more. So that's where we're really looking for exposure there, those that end up in a stronger position down the track once all that stuff cycled through. Move away from stocks a little bit. We've just got a slide here talking about style neutrality and the benefits there. So I kicked off, I guess, this webinar talking a little bit about how we look to invest actively, within the current market environment, but also, all market environments. And, the key point there was being style and cycle neutral. The very foundational approach of using Sage groups to find stocks with a degree of commonality there that tend to cluster together in different market environments and regimes. And this can take on different dimensions at different times. So that chart there on that slide, this is just looking at within the US, it's a big liquid market with a long history to look at, but looking at the relative performance of the MSCI growth and value indices and how they've done through time. So, and not surprisingly, through the 70s and 80s, higher inflation, value did very well. As bond yields collapsed, as inflation came down in the late 90s and with the tech boom, growth was very strong, and you had a lot of cycling around at various stages through there as well. And obviously in the last couple of decades, growth's been very strong with a brief little rotation to value in the middle there as, we've seen basically real yields go to zero and negative as central banks have tried to reignite inflation past the GFC. So that's an environment where you can pick a style and be right for a long period of time, and that can lead to great success. But one of the core beliefs we have is that we want to be able to deliver returns in different market environments, and sometimes those regime shifts can occur quite suddenly. There's a lot of debate occurring at the moment in terms of inflation and where that's going. Are we moving into a new inflationary environment? There's certainly some new characteristics occurring within the market that we haven't seen in the past. COVID has really unshackled governments from fiscal austerity. So one of the features of the financial crisis was really the collapse of the banking system as a result of too much debt. A lot of that was private sector debt, but as a consequence of that, the public sector took on a lot of debt. But there's a real theme of getting that under control. Austerity, it nearly blew up Europe again as they tried to limit debt there. You had debt ceiling issues in the US, which constrained growth and had issues of double-dip deflation. And without that fiscal support, not surprisingly, recovery was long and protracted, and there wasn't really, inflation came back to pretty much normal levels despite what the Fed will tell you, but never really a big surge in inflation. Whereas COVID's really unshackled fiscal spending. So we've seen, I think, US budget deficits like 15% of GDP this year, maybe even heading further north, and that's been the theme all around the world. So a lot of fiscal spending. Potentially we're in a different regime where the impacts of globalisation has peaked out. So China's entry into the WTO in 2000 unleashed a wave of low-cost workers to the world, which was very deflationary for manufactured goods. So you saw a lot of transition occurring there across the world. So whilst we've been in a growth regime for the last 20 years, and that style's done very well, maybe it continues. We've got a slow recovery. Central banks stay very accommodative. We've got low rates, and growth does very well for the next decade. Or maybe we're in a regime shift, inflation comes back.
feel like we've had 3 shifts in the last 12 months.
And the last 12 months, it's rotated at least 3 times. So we might get a more longer lasting shift as well. So one of the core beliefs we have is that rather than just tossing the coin and trying to work out which regime you're going into, build an investment process that operates across those different regimes. And that comes back to that segregation of the market into those broad stage groups, so that a degree of neutrality there means that you're not taking on style buys. The long-short structure means that you can have a lot of different views about companies within those groups, how their fundamentals are changing, and there's a lot of diversity across the equity market. There's always a lot of companies going up and down, and an investment process that identifies those and a structure that enables you to benefit on both the long and the short side means you can drive active returns across those different regimes. So that approach of long-short to provide opportunity and style neutrality means that you can generate smoother long-term returns independently of those regimes. So that's, I think, a real benefit to investors, something that we really focus on as a core foundational belief at Sage Capital. So that shows up just within our positioning. So if you're not familiar with this chart, this just shows our absolute return fund. So this just has pure stock selection exposure, no market exposure. But it shows our gross long and short positions, so long on the right and short on the left, across the different 8 stage groups, and the dark bar being the net positioning there. So you can see we've got a lot of different long and short positions on within those different groupings, but the overall gross exposure, the net position between them tends to be very small and doesn't really dominate returns. So we'll make sure that our views on where the world is going is consistent with that positioning and flows through to companies within there, but we're not taking a big style position in terms of what regime we're moving into or where we're at. So that really drives that style neutrality and that consistency across different market environments.
As I said, crazy 12-month period with the first off started with a big growth rally straight out of COVID, online everything, and into a tail end of the year, you went back into a cyclical inflation rally, and maybe you're seeing a little bit of a growth rally too as the 10-year comes down in the US and there's a bit of relief there. So I'm glad we're not taking huge style bets there, because you could have been blown out of the water about 3 times.
Yes, no, helps you sleep at night, that's for sure, and having a young child, you need all the sleep you can get, so it's very important. So just moving on to a little bit more detail on a couple of the stocks that we were talking about earlier on. So we mentioned CSR and Adelaide. So James, CSR sits within the domestic cyclical grouping. Tell us a little bit more about it. What's this guy doing on the roof?
That's plasterboard there. That's about the most exciting plasterboard image I could find looking through, which is a bit disappointing. But as you mentioned before, it's the highest exposure to detached housing construction in Australia, and it's really been a well-managed business over a sort of a 10-year period, generating good returns, growing strongly, investing its capital in a smart manner. And at the moment, it's taking share within its actual core market. Not only is the market growing, but it's taking share within its core market off Boral and Canap, due to them both being a bit distracted with various other measures. Boral's obviously doing the US sell down, the fly ash sell down over there. There's a lot of strategic vision about where Boral's going to end up. And that's meant that CSR is able to really take advantage of this and grow quite well in the domestic market. And I think one of the last aspects that people don't really see with CSR is it's got a lot of old brick facilities out in Western Sydney in some really good areas, industrial grade areas, what we've seen across the market.
Adelaide or something like that?
Yeah, around the second airport there. And what we've seen across the board is that the cap rates or the valuation rates for Western Sydney industrial properties have just gone through the roof recently. There's been a massive push with COVID to online distribution centres and fulfilment centres, and their property book probably, there's some remediation costs in there, but it is valued about sort of $5 and sort of underpins most of the valuation of the stock price even today. Yeah,
and I guess one of the things we like about James Hardie is the technology portfolio that it brings in terms of fibre cement and the barriers to entry that creates. And CSR, plasterboard doesn't have a lot of barriers to entry other than scale, but they do have some technology within there, things like Hebel and autoclaved aerated cement and building blocks and different solutions and building solutions and the like, and roof tiles and bits and pieces.
And those segments are growing quite strongly too. They're growing well above industry growth levels as they are, pushing ahead there.
So that's certainly also positive. And so controlling our exposure to domestic cyclicals, we want to be long CSR, benefit from that growth in detached housing.
Much better photo too.
It's much better photo. We should probably point out that's not an Adbri truck, so that we don't get sued. In fact, I'm pretty sure Adbri don't actually do ready-mix concrete, but it's a good image anyway. So, James, talk us through Adelaide Brighton.
So Adelaide Brighton, if you look at the history of the stock versus, say, a CSR, the most staggering thing is there's been no growth here over 10 years. And the reason there's been no growth here over 10 years is increasing competition from both domestic supply and imports, which has really created a tough market for them where margins are constantly under pressure. And I think the biggest case we saw there was the lime contract they lost with Alcoa earlier in the year, where they were earning like a 2/3 margin in that business, and it was a big drop to the bottom line from one particular contract that was overpriced, and they basically said, we're going to find alternative supply from international because we can bring it in at a cheaper rate than you're supplying it to us domestically. So its housing exposure, although it does have some positive housing exposure, it's very much geared towards the multi-res end of the market, and that's, as we talked about previously, really under pressure and been a real laggard over the course of the year. As you mentioned too, the commercial exposure, where infrastructure's been running hot for 3 years, so there's a lot of talk that they're going to extend that cycle out, and people are factoring in that with ABC's numbers, but even with that, it's really struggling for growth over the next 3 years, trading at a valuation that's still indicating that this is actually a growth stock, not a sort of struggling structural loser.
Yeah, state governments have certainly been spending a lot of money on tunnels and roads in recent years, so hard to accelerate demand from there. But yeah, imports from clinker and the like, more grinding capacity and the like, competition, structurally low barriers to entry can make it a bit of a hard slog.
When in an industry with structural low barriers to entry, you really can't slip up, and I think there has been some slip ups there across the recent years.
Yep, so a good funder for our long CSR position. So that's sort of bringing it towards the close of our webinar. So I've harped on about a few of these things. Style and cycle neutral approach is very important, but the two different funds there that meet different investor needs. The absolute return fund offers uncorrelated returns to the equity market. So it's got a cash benchmark, pure stock selection from Sage Capital, and the Equity Plus fund, if you want equity exposure, provides that with long-short enhancement with a 4 to 5% tracking error and return target above that index.
We've got a question or two there, do we?
Yes, yeah, we do. So Sean and James, really appreciate your insights, but we've got a question, and please submit your questions through the box. We've got a few already, but we've got one that just asks, how is the fund position for large drawdowns? And I think March last year was a really good testament to your style and the way that you manage money. But I think more importantly is how are you able to consistently, and I know you touched on it, where the process, identifies regime changes, but it'd be good just to give a sense to some clients, how's it positioned for large drawdowns if they occur, and then doing it in a very layman manner would be great. Yeah,
I've certainly, unfortunately, been working in the markets for long enough that I've experienced a few large drawdowns, not the least of which was last year, but the GFC was probably a bit more drawn out and dramatic than that, and a few other bits and pieces along the way from LTCM and Asia-Russia bond crises and all sorts of bits and pieces, tech bubbles exploding. So there's been some opportunity to experience drawdowns. I think the first thing worth pointing out is that there's a lot of different long-short funds out there doing different things. And sometimes when people see short in a fund, they think it provides natural downside protection. So it's probably worth pointing out that we still either have exposure to the market in the Equity Plus funds, beta 1, or just no exposure to the market in the Absolute Return Fund. So the Absolute Return Fund's got no actual exposure to a drawdown because it's got no equity market exposure.
Actually performed quite well in March with the high volatility. There were plenty of opportunities, and I think we ended up the month quite strongly above 5%.
So it's uncorrelated. So it's back to our stock selection and can go up in a falling market, which is what you want. It's not guaranteed to go up in a falling market, but certainly can do so. The equity plus fund, hard to actually avoid large drawdowns. So we do run beta 1 there. So you will still, if the market falls 30% and everything falls by 30%, it's very hard to avoid that. So we don't put like option derivative overlays in place, and it's not a variable beta fund. So we don't sell out of the market and try and time it and those sort of things. But as you mentioned, what those large drawdowns do is give you different opportunities. So it's always worth bearing in mind what is causing that drawdown. So what we try and do in those environments is position the fund to be as capital protective as possible in that drawdown environment. So for instance, last year, with COVID outbreak, there's some obviously clear implications of borders shutting and cafes and restaurants shutting, employment shocks and the like. So big economic shock, we cut all our travel exposure and took some shorts on there, looked at balance sheet strength, so companies with high leverage, credit exposure, we exited or put shorts in place, and companies with high valuations based on cyclical growth are also vulnerable. So there's a lot of opportunity to actually use the shorting part of the portfolio to benefit from a falling market there. And similarly back in the GFC where the real liquidity crunch, so anyone that had debt due on their balance sheet or a lack of liquidity there or was banking over the wrong people, looking at what's driving the issues there and cutting exposures or taking shorts in the right areas, going defensively, looking for the beneficiaries. One of the things last year that really worked well for us was identifying the need for, say, respiratory care in a long ResMed, long Fisher and Paykel in that sort of exposure. So how are we positioned now? We're not really positioned for a drawdown because there's not anything like that on the horizon in terms of big economic shocks. What you'd see in the market drawdown at the moment would really be a sort of valuation correction. And that's sort of what we experienced a little bit over the last quarter with bond yields and yield curves backing up quite steeply and certainly started pressuring the growth into the market. So at that stage, we were a bit underweight growth stocks and had some select shorts in the punchier end of the market there that helped us drive some good returns over the last quarter. So there are ways that we can benefit in that environment.
And there's another question there about managing gross and net exposure, and that's probably an interesting point too, that we did bring gross exposure in. There was an increase in volatility, so we do target volatility quite tightly. If there is a drawdown, there is a spike in volatility in the market, like we saw in March.
Yeah. So generally, when you have a large drawdown in the market, volatility is going through the roof. So that's something we do try and manage dynamically. So manage our risk in that environment. So we do bring our positions in to cut exposure because it's not guaranteed that our stock selection will add value there. So you don't want to compound risks by not controlling your actual underlying active risk in the portfolio as well.
And I think we've got time for one more question just before we hit our time limit here. But I guess, a client's asked what would be the worst case scenario for the absolute return fund, a short squeeze, factor crash, or I guess an M&A cycle kind of occurring. So it'd be kind of interesting to get both of your opinions on, what could be the culmination of factors there.
The last point of that too, we had last quarter, we actually had, because we run such a diverse portfolio of 100 positions, we actually had 3 of our short positions were taken over during the last quarter, which was quite unfortunate, but we still produced reasonably good returns. I think we were up quite strongly.
Yeah, we had a very good quarter.
Yeah.
So that's the point, we run a diversified portfolio, so there's over 100 active positions there. And, naturally, M&A is always the bane of a long-short manager because generally some of the worst performing funds get bid for or taken over, and you'll lose a little bit of money there. But you make a lot more money on all the other short positions you have where the company's struggling and stock price is under pressure. So we're always prepared to give a little bit back for one-off. Same with a short squeeze, unless it's occurring right across every stock in the market. And because we run a broad independent investment process, we don't just go out and short all the top heavily shorted names. I suspect sometimes we're the only person that's short a particular stock in the market at the time. So we're not overly exposed to short squeezes. We might be short a couple of stocks with high short interest, but by themselves, they're not enough to really blow up the portfolio. So I think factor crash is probably more of a risk. We are pretty style neutral in that we're not massively value or growth tilted, but you can get risk of the drawdown. So a factor crash, something like momentum. So it's a broad factor in style of investing. It's something that's also quite highly correlated with volatility and risk in the market. So, for instance, last year when COVID broke out, or back in the GFC, volatility spikes up, momentum tends to perform very poorly, and we're very cognizant of that. So if we'd blindly followed momentum within our quantitative process, that probably would have drawn the fund down. But we do have some switches in our framework that turn momentum off in that scenario. So we manage that one that way. But drawdowns of the fund are generally, there's always a degree of randomness in markets. So we've got investment skill that we've demonstrated over a long period of time, but making good investment decisions is not a guarantee that you'll get a good outcome, because other things can drive the market, from liquidity. And when you get a more disconnected market, so more retail participation, everyone takes their profits from Bitcoin, Ethereum and Dogecoin and goes, I'm going to go and buy a range of stocks instead. That could drive some real dislocations across the market. So that's sort of irrational behaviour. Markets disconnecting from fundamentals can drive a drawdown in the market. But we're never afraid of that, because over time fundamentals tend to reinsert themselves, and that often creates opportunities. So we do look to control risk across a lot of those different exposures, but our greatest defence is diversification. That long short structure, the ability to hold a lot of different stock positions in that style neutral sense, is our biggest protection against material fund drawdowns.
Fantastic. Well, in conscious of time, I just wanted to say thanks to Sean and James for your time today, and the audience for your participation. And for those questions that we didn't answer, we'll certainly come back to you on email. We will be emailing the presentation to you shortly. If there are any further questions or you'd like to know more, please reach out to the people on your screen there, and have a great day. Thank you so much.
Thanks, everyone.
Thanks, James. And thanks everyone for your interest.